Good morning, ladies and gentlemen. Well, by my calculations, the risk dial is slightly positive actually now, which doesn't really mean anything because we have a very important week ahead of us with CPI, and it will decide what the Fed will do next. I think my high bar after NFP for a 75 basis point hike has been met, and that has very, very big implications for the yield curve. So without much further ado, let's have a look at what the yield curve is saying at the moment in what could be a very, very wild week. If we start with the 2s, 10s, I've now switched to a monthly chart. You can basically see that we don't have any support until, I don't know, minus 50 would be my fundamental support, but it can go a lot further than that. It can go to minus 100 basis points without any problem. NFP has shown that the economy is still relatively strong and that the Fed needs to keep on hiking. We're not going to learn very much from 2s, 10s. You saw that 2s, 5s, which in that email was pretty critical around the 25 basis points, closed below minus 25 basis points, and it could easily go to minus 50 or minus 70 basis points. Therefore, all the pressure is going to be on the 2s if CPI is high. If CPI is high, I really expect minus 50 to be seen very quickly in 2s, 10s. If it's not, it could easily come back. And if we have a look at a daily chart, it could easily come back to around minus 22, minus 23. But I think the pressure is going to be continued onto the short end. I much prefer to look at 5s, 30s. I think they give you a far more nuanced view of what the yield curve is doing. And here we have this very, very important level around minus 11 basis points that that is in red. To me, if we go through there, the yield curve is going to do really stupid things. And if we go back to this is a period in 2000 when it went through, it went to levels around minus 40, minus 50. If we go back in time to the last time there was some significant inflation, and you can see here what it did in the beginning of the 80s, it went to 112 basis points negative and even 145 basis points negative. So you can see how volatile the yield curve can be in the 5s, 30s when things, when the belly blows, the belly blows. So 2s and 5s extremely, extremely dangerous for the next few days. Just to show you how dangerous the belly can be, the 5s, we're here looking at a weekly chart of 5s, 10s. And this red line to me was very, very important, and we keep on going above it. We just cannot come below it. So if we look at what happens when this red line gets broken, you could easily go to minus 33 basis points. And if we go back to what happened in the 80s, you went all the way to minus 77 basis points. So you can get very, very vicious moves. The 5s are going to be very dangerous. And why? Because if the market decides that inflation is such a problem that the Fed cannot do a turn in the foreseeable future, well, the 2s go, but the 5s go with it. If they decide that it's a medium-term problem and it's no longer a short-term problem, the 5-year area gets annihilated. So be very, very careful with fives. And I just can't stress that enough. The first move can be very violent, can be 30, 20, 30, 40 basis points in the 5 year, which will have, the euro dollars, the 23s, the 24s, and the 25s will lead, but the 5 year note could easily follow. As to the individual tenures, I've now switched to a monthly chart of twos. And I don't know if you can see all these dots here where they were trading back in 2006. We have now the highest level that, if the month were to close now, we would have the highest level that we have had in twos on a closing basis. It never closed above this very important level to me, which is, as you can see here, just below 3%. If we now go beyond the highs that we saw at 340, I really don't see it stopping until we get to this kind of level, which is going to be, well, around 4.5%. What would that imply? I mean, that would imply that it's a Fed that's going to do at least another 2 or 3 75s or 100 and a 75, i.e. an acceleration. I think core CPI is going to be absolutely crucial here, but we could easily see a test of this level here, which is just below 350, 346. And if it goes through it, I think it's going to go through it to at least 4%. So big moves in the twos and the fives as well, as we'll see now. Well, on Friday the fives held the 299 level beautifully, but I think if core CPI is bad, I wouldn't say that it necessarily has to be bad. Well, yeah, it needs to be at least 0.1 higher than expectations. I think the twos will get murdered anyway, but the fives really will go above 299. I'm pretty damn certain. And the first stop is going to be this area around 318 to 320. But easily we could fill this gap all the way up to 337. And that's basically my expectation for the fives for next week. But after that, if we start trading up here, we'll start negating this ABC and basically saying that we've got another leg up above this very important level here, which is exactly where I bought them, 359. You start getting into, if we go back in time, you have gaps, you have big moves. You see, this is the red line. Through it, and we start looking for 460. Okay, so we are looking for almost a percentage point for this to go, almost a percentage point. And that is what I showed you in the yield curve. When the twos and fives go, and especially when the belly goes, when people are convinced that the Fed is going to be higher for longer, they just completely give up on the belly and they just sell it and it just goes. So be very, very careful next week. Of course, I'll be tweeting to you every step of the way, but the real danger is in the twos and fives. The 10s and the 30s have been much better behaved. I mean, much better behaved than the 2s and 5s. What does that tell me? That tells me that the market still has confidence that the Fed can kill inflation. All it really needs to do is hike rates far enough. Now, why would that be? Why are we probably not in a period like 79, 80, 81? Because we don't have the acceleration in wages, and we don't have the acceleration, the monstrous acceleration in commodity prices. We have a one-off event that the Fed should be able to tame with higher interest rates, which could last a year, 2 years, whatever. But the 10s and 30s basically are telling you that it's whatever it lasts, and however long it lasts, it's not going to be 10 years, and that they will succeed in taming inflation. How far can we go in the 10s? Well, to me, this 323 level, 324 level is key on the weekly, but we haven't even filled this first gap, let alone these gaps up here, which were at what, 330, 331. So to me, that indicates that really anywhere around 298 to 303, the 10s should top out. And it's the yield curve that's going to take the strain as opposed to the outright in 10s. If we look at the 30-year instead, and now I've given you a weekly chart going, a long, long way back, you can see how important this 345 level is. Can we go back to 322, 319? Absolutely. But I really don't expect it to be any worse than that. This kind of stuff. I really don't think that the problem is in the 10s and 30s. I think the problem is in the potentially in the much shorter end, simply because I do believe that this is a transitory phase. It's just not transitory in the way that the Fed tried to define it, i.e., a couple of months. It's probably a couple of years, but that should not affect the longer tenures anywhere near as much as the short ones. And I think these charts prove it. Every time interest rates go up, we get a calmer period in the five-year forward inflation expectation rate. It's basically bouncing around between 230s and down to 205 or 210 or whatever. But it's contained. It's not trending up, which means that every time that the market pushes up short-term interest rates, the inflation expectations in the future drop or stabilize. If we look at the 10-year break-even inflation expectation rate, same story. So every time rates push up, you get a calming effect on the inflation expectations. This is not something that you would have seen during the 70s or early 80s. The market is basically telling you that the Fed will succeed in taming inflation. It's just a question of how long it takes and how high they have to take short-term rates to do it. But they will succeed. And the market is basically telling you that the longer end is fine. The question is, what is the appropriate level for the short end? I thought it might be useful for you to see the futures yield curve. These are the yields in terms of futures prices. What is going to happen if CPI is bad? Well, the curve is going to pivot somewhere around the 10 to ultra 10 or T-bond area. These will go up, but these will go up far more. And you are going to have a curve which is going to be like this. So all the danger is going to be that the twos go to, above 350, 360, basically discounting a 75 or 75 plus basis point move at the September meeting. and then probably another 50 to 75 after that, so another 125 points of tightening, and basically a how shall we put it, a terminal rate which is going to be somewhere around between 3.5% and 4%. So you could easily see the twos go up towards the 4% area without any problem at all. Whether it lasts or not is a completely different matter, but that could be easily the market reaction. And the tens will go up far less. They might go up to 310, but you could have a much steeper inverted yield curve, which is going to pivot around this area. What about European yields? Well, to me, the Schatz, and this is the Schatz, has absolutely no value. The risk reward in it is awful in owning it. I don't care how, all these arguments about there is no collateral, there's this, there's that. To me, this is, inflation is something which central banks have to tame, and have to tame through higher short-term interest rates. The Schatz, to me, is an accident waiting to happen. I fully expect it to trade around these levels, which are around 64, 65 basis points. Initially, you can see how many times it traded there. And then I really don't, if the CPI is bad and the US twos are tanking, I expect another retest of the 108 level. I really don't see that there is any hope for the Schatz in terms of risk reward. If we go and have a look at the bubble, this is now the bubble. To me, it has to retest this 94, 95 area. This is a weekly chart, and you can see how, to me, that basically what it's done, it's tested back to the 0.618 retracement of this move since Ukraine got invaded. To me, the neutral point would be somewhere around there, 95, 96. Looking at the bunds, they've actually traded quite well. They've held the support. And now I would have thought that an area around 113, 116 is going to be pretty neutral for them. And why not? French market, I think that's traded pretty well technically. I would have thought 171 is the likelihood that we trade, but you can see how the longer ends are much calmer than the shorter ends. The problem is US for now, but if the CPI is high, I don't think that the European markets can withstand it. I think the bunds trade at least this 171 area. I really don't see any two ways about it. European rates have to go up in sympathy with US. If we look at the differential between Germany and the US in the 10-year, basically it's gyrating between a high around 200 and a low around 160, 154 area, this 151 that I think is so important. If we switch to a daily view, you can actually see that on Friday it did very little. It did nothing. Every time it gets to these high 190s, it just too much for it, and it slowly starts turning over. And I think this will continue. Why? Because imagine if we now started going to 205, 210, 220 on the upside in this differential. Well, what would happen? The euro would absolutely collapse. And if the euro collapses, then financial conditions in the euro area are becoming even easier, and they're already pretty damn easy. and that is basically negating all the work that the ECB is doing. And I just can't see that the ECB can tolerate that, because then they're in the worst of all worlds. They are tightening for no reason. And that is going to be very, very problematic. And that is why I think that I really cannot see any value in the short end of the German curve like Schatz. I think the risk reward is massively to the upside. Now, without knowing what CPI is going to be and what the reaction of the yield curve is going to be, I can just say that the dollar is in a technical position to screw every bear out there. You can see how basically we have corrected all the overbought indicators that we had when we were at 108, and we are what, at 106.57. So just by doing very little to the downside in the space of 2 weeks, we have enabled this market to try and make new highs. And you will remember from this chart, from the weekly chart, and if we go back in time, that every time it's gone above 106.25, and that's a long way away, it has basically traded up to 111 and even higher. 106.25 has been a hesitation area for many. This is a weekly chart, so you can see how much hesitation there's been on the way up and on the way down. But every time it's gone through at least 111, and then hesitation and then higher again. So we are in a position for the dollar to move higher if CPI allows it. I think what the market is basically saying is that, if we are going to get 4% plus in Fed funds, and we only, the short-term differential, as I've just told you, between in the very short end between Germany and the US is widens in the very short end, not in the 10-year, then you will get upward pressure on the dollar to go back up towards 111.30. To me, it's interesting that Euro USD just cannot even test its 103.40, 104.37 area, which gives me a good risk reward to go short of the Euro USD. It's corrected on a daily basis, and it could easily go down to par now and through. I would have thought that, sort of on a high CPI, it tests just below par without any problem at all. The weeklies would allow it, and then we see. But, high CPI, I just think the terminal rate that the Fed is going to impose on the market, and the fact that the market is going to price something which is going to be higher for longer, which is really key. I think the fact that all the easing, pivoting expectations in early 2023 are going to be taken out the market is going to be enough to give us a decent push below par in Euro USD. Gold continues to play its silly game and basically just bounces around. It's reaching the 1830 area. Let's do this. At 1830, there's very, very little reward in being long of gold. It tested the first resistance at 1810. 1764 is an obvious swing level. If the data is bad, i.e. if CPI does not help, I would have thought that we we could easily return to these lows, if not spike them. It's very, very vulnerable. And really the reason why I think it's vulnerable is because of the chart of gold against copper. Right, gold against copper. You will probably seen the tweet by Gundlach saying gold copper ratio is actually saying that 2-year yield should be nearer to 2%. Well, the reason why 10-year yields could go to 2% eventually is because the Fed hikes so high that the economy basically gives up. And then 10 years will be at 2%. Just that the yield curve in the meantime is going to go as steep as anything, negatively steep, as inverted as anything. And that eventually produces the crack, which gives us 10 years at 2%. But in the meantime, I would have thought gold copper is far more likely on a high CPI number to come down towards 10, and then 6 months from now it could go a lot higher. So that is the possibility, and in fact the probability. When we're always playing probabilities, and if it starts going down, I doubt that it's going to be copper that takes the strain. I think it's much more likely to be gold that takes the strain on the way down to test 10. Oil is quite interesting. I think could easily be that it has topped, and really that it has a rendezvous with this 75 area that basically has been the middle for such a long time, the middle of its range. If you look on a daily basis, it's broken the 200-day moving average. What it hasn't done is the spreads are indicating stability around the high 70s. So it's just the front end of the curve, and I'm not showing you the curve, but believe me, it's true. It's only the very front end of the curve which is coming down. The back part of the curve is very stable in the 70s. And that suggests to me that the market is being drowned in oil at the front end. Basically, it's a political thing. But that does not exclude that the market, you can see what it does. It breaks and it comes down to the 75 area, and then it bounces again. And this kind of thing suggests to me that it's not the very long end in bonds that is going to be attacked ferociously in terms of higher yields, whatever the current CPI is. Because if the price of oil is going to stabilize in the high 70s, low 80s, that is really not a reason to panic. I mean, we spent a decade in that area, right? The best part of a decade without inflation. It really doesn't make much difference to me whether CPI tops in August, September, October, November, December. How does that matter for 30-year bonds? Well, it matters for what it's going to be this week as opposed to next. But it really does not make long bonds go from 3% to 350 and then higher. It's not something that really matters for the long end. It's something that matters for the very short end. And this kind of behavior tells me the long bonds are not the ones that are going to get murdered. If we look at DBC, it's on the dailies, it's sitting right on the 200-day moving average. Okay, so I know that oil is a large component in DBC, but also we are here at 243, which was the low for the whole period between 2010 and 2015. Okay, so how is that hugely looking forward to huge inflation in the future. It's not. Okay, so another indicator to me that the long bonds are going to be fine. If now we start breaking 24.39 on a weekly basis, that's actually going to be disinflationary. So I really think that it's going to be the yield curve that takes the strain, not the individual tenures like the long end. Well, the expectations of the Blue Angels are finally turning, and it's, to me, it's unlikely that we really start breaking times 18 in this environment, simply because, you know, I don't think long bonds, however little they go up in yield and however much the yield curve pivots around, you know, around the tens, it's not going to be bullish for long bonds if CPI is bad. But, you know, the way is open if CPI is good for a test of the times 18, which is around the 4,300 area. That is for absolutely sure. One thing which is really interesting is that the term premium has absolutely collapsed. And while I would like to see a jump in the term premium back up to zero, and I think we will get it, that is not hugely bearish for equities. I'm beginning to prefer equities over certainly the short end of bonds. I think the reaction down in equities, whatever CPI is not going to be nearly as bad as a lot of people fear. I want to show you several charts of the SPX, and basically the first thing that has to be ingrained in your mind is that unless we break 4068 on the downside, there is no correction. Okay, that there is no correction. What this week has done, in which we've done basically absolutely bugger all, is opened up the Bollinger Bands on the 195 and giving us the opportunity to go up to the 42.55 area, or beyond for that matter, in a few days. That to me is very significant. So we are in a 50-50 kind of here, and unless we break 4068, we are definitely going up. Why am I showing you this one? Because 4068, you break below, you have a long way to go until it stabilizes around this 3910 area. That is going to be the first area of stabilization that I can see. You can see how it was for a long time. That's going to be the first area. Everybody's going to be as bearish as hell down here, and I think that's probably where it bounces. But having said that, let's look at the other charts. Still bear in mind this monthly chart, which I'm now going to enlarge here. I think this area here, that where we are, is very, very, very important. You know, can we go into this kind of area this month, 42.50, easy, yeah? But what we have to do is close below 41.81. Otherwise, we are definitely going to 43.95 and just bouncing around. And it's no longer a bear market, I don't think. I think it's, you know, it's going to be very, very interesting to see where we close this month. So getting rid of this chart, I want to show you a weekly chart as well. And you can see how we are at a very neutral level in the weekly chart. I would expect this 42.25, 42.40, whatever it is, to be a very, very big test of the SPX. I really would not expect it to hold because A, it's very close to that times 18 Blue Angel, but also it's a level on the monthlies and on the weeklies that we really should not break through. But I expect that any kind of bearishness is going to be confined to this area, 39.40, maybe 38.61. I don't think we go and test the lows again because the term premium is too low. And also because I just don't think the pressure is going to be on the 30s. And and you have the equities being much more sensitive to the 30s than they are to what the short end does. If people start panicking out of equities because the short end is going to go to a higher terminal rate, I think that is good for equities in the longer term because that will mean that inflation will be beaten, and that will mean that the economy will recover that much faster, and also that when the term premium stays low, that the equities have to be valued higher. So I would have thought that any kind of a test of these levels lower is actually going to be bullish rather than bearish. Now the XLY XLP is at very interesting levels, as you can see. It's done exactly the right thing. I mean, the thing that I expected. It's corrected the oversold, and now it's going to do one or two things. It's either going to go a lot higher or retest the this area here around the lows, which tells me that the move in XPX is going to be one way or the other. And I know that's not telling you much, but what it's telling you is that it's going to be sustained. Okay, it's going to be either a retest of an area around the lows, and I just showed you where I think that stops, or it's going to be a continuation move. The reason why I can't see it being a strong continuation move at the moment is because with higher interest rates, the purchasing power of the consumer, and therefore the ability of XLY to start trading back up here, to me is almost impossible. And therefore I think, and this is really not based on anything but a feeling, that we retest the downside first before we stabilize and go back up. And I really cannot see, a continuation higher if we get a strong CPI. If we get a weak CPI, I can see it. But a weak CPI changes everything. Basically, then we say we have topped. We have seen the high terminal rate, and if we've seen the high terminal rate, there is no reason not to buy equities. Let's face it, the best indicator for several months now has been volatility. Does it go up or not when the S&Ps have a bit of a wobble? And what do we have here? I mean, let's enlarge this and have a look. What we have: 1, 2, 3, 4, 5, 6, 7, 8 weeks of lower volatility. And we just can't, every time we close below 30.11, it just keeps on going. Well, we're on the 200 week, these kind of levels have been the lows for a very, very long time, and after that there's a reaction. That's why I want to see volatility pick up before I make any kind of decision on what I want to do with equities. But if we get a quick spike in volatility which doesn't break or close the week above 30.11, it'll still be for sale, and that to me indicates that equities are a good sized dip to a decent level is going to be a very good risk reward buy. Now, what I would like to see on let's say a higher CPI is the reaction of NQ. I think if NQ does not break 12,430, that it's going to be a very good sign. And also, if the yield curve if the 30s don't start breaking the higher levels that I showed you in earlier around the 319 to 392 area, and that is all that happens, then I would have thought that NQ is going to start being a very good buy around the 12,450 area. And we could then be in a much healthier position to start attacking up towards the 14,000 area. That's, to me, the higher probability than not. But really, I would have thought that before CPI, or even before CPI, if you see 13,700, it's a big short, because the probability, the risk reward on a high CPI is going to be massively down. That's why I don't think you can see it in the first 2.5 days of next week. I don't think you will see 13,700. But if I do see 13,700 before CPI, I'm buying puts, that's for sure. Just so that you can see how important that area is, 13,700 or 13,816, that is basically where we topped out and stayed topped for a long time back in 2021. And the area that we basically just went up and down in, and the first support after the break. So that to me is going to be absolutely pivotal. Whether it's 13,700, 13,800, who cares? That level is going to be very important before and after CPI. If you see it before CPI, it's a given. You look to short it. But if it's after CPI, that will have some meaning. And really, all equity markets are getting to levels where they could top. Here we have the stocks, getting towards that 38.40 level. Whether it's 38.80 or 38.43, I'm going to start getting short at 38.43. But also much the same thing for Nikkei, which is completely distorted by the A, the Bank of Japan, and B, the yen. But you can see, to me, this 28,180 on the weekly becomes very important. The Bollinger Bands are here. We could go and take out these stops, which must be here, trade up to 28.7, something like that. And I would have thought that would be a good risk reward short before CPI. But if afterwards if we close the week above, 28,335, that's going to indicate that the pressure is coming off equities, isn't it? And to me, that is going to just signify that it's going to be the yield curve rather than the individual tenures which take all the strain. I've updated all the levels. I think it's going to be a very crucial week for the yield curve, and especially for the 2s and 5s. I really don't think that we are going to have a very good read from anything before the CPI, i.e., let's wait for Wednesday. But I think the risk reward, I've added the Schatz, the risk reward in Schatz is significantly to the upside. That's the risk reward. And all the other bonds I think, are going to get a shock from CPI if it's bad. The first reaction is going to be very, very steep. it's a reaction that I want to buy in the 30s, but it's not a reaction that I want to fight in the 2s and 5s. And I'll be tweeting what I'm doing throughout the day. Hopefully, it's going to be quiet Monday and Tuesday so we can prepare ourselves mentally for what happens on Wednesday. Good luck to you. I'll be with you every step of the way, and have a wonderful weekend.